Hello everyone, welcome back to my channel CMA Future. Um, okay, today we are going to explain about difference between bookkeeping and accountancy, management accounting and financial accounting. Please students, please do share my video and subscribe my channel. Okay, so difference between meaning bookkeeping accountancy meaning bookkeeping is considered as end part it is accountancy first starting we begin the accountancy functions the primary stage of accounting function is called bookkeeping overall accounting functions so this is a part of accountancy bookkeeping is a part of accountancy as I said in my earlier video so it is a primary stage overall accounting functions are guided by the accountancy depends bookkeeping can provide the basis of accounting accountancy depends on bookkeeping for its complete functions so we record the bookkeeping then we do other functions like trial balance profit and loss account balance sheet these all things will complete the functions it depends on bookkeeping how we record the transactions like that we are going to complete the functions data the necessary data about financial performance and financial positions are taken from bookkeeping accountancy can take its decision prepare reports and statements from the data taken from the bookkeeping from here we start so we are going to prepare reports and statements from where data taken from bookkeeping next comes recording of transactions financial transactions are recorded on the basis of accounting principles concepts and conventions accountancy does not take any principle concepts and conventions from bookkeeping okay it has its own rules management accounting difference and financial accounting in the last class I had explained what is management accounting and financial accounting properly so we'll see the difference management accounting is primarily based on the data available from the financial accounting so what the management does or managers do the managers collect the data from the financial accounting and as well as cost accounting here it has not been told cost accounting because we are dealing with financial this it is with financial accounting so you can write even that also but there is no need okay financial so they collect the data from there so that is the first point financial accounting is based on the monetary transactions of the enterprise so whatever the good or transactions are conducted that is monetary transactions that is based on accounting financial accounting is based on monetary transactions it provides necessary information to the management to assist them in the process of planning controlling performance evaluation and decision making okay what the management does the management collects the data then analyzes it analyzes it and interprets it what they interpret for what reason in the process of planning future planning decision making how the entity should grow how the entity should perform those all things the management does its main focus is on recording and classifying monetary transactions in the books of accounts and preparation of financial statements at the end of every accounting period so what our financial accounting does it records and classifies the monetary transactions journal ledger as we saw in earlier classes journal ledger subsidiary books trial balance these all things financial accounting does and then what it does prepare the financial statements that is trial balance profit and loss account and balance sheet so it prepares final accounts and then what at the end of every accounting period every year they prepare that is accounting period in management accounting reports prepared in management accounting are meant for management and as per management requirements so whatever the final reports are prepared by the management it is meant for them and management how it requires, as per that they prepare. So reports as per financial accounting are meant for the management as well as shareholders and creditors of the concern. They not only provide it for the management, for shareholders and creditors also. Financial accounting is means profit and loss account and balance sheet, they provide it to the shareholders and creditors also. Okay. Next comes reports may contain both subjective and objective figures. Both the figures will be contained. In financial accounting, reports should always be supported by relevant figures, and it emphasizes on the objectivity of the data. So, in financial accounting, main relevant, whatever the relevant figures are there or related to the business, those are recorded and those are reported. Next one, reports are not subject to statutory audit. Reports are always subject to statutory audit. Statutory audit is a type of audit. In auditing subject we will learn what is statutory audit. So what is statutory audit? It is an inspection made by the organization about the financial recordings. Okay. They come and externally they come and they do the financial inspection of the financial records. So management does not need it, but financial accounting needs it. Next comes, it evaluates the sectional as well as the entire performance of the business. It ascertains, evaluates and exhibits the financial strength of the whole business. So this what it does, it evaluates only the sectional and entire performance of the business, how the performance is in this accounting period, how the business is performed. It only evaluates that. But financial accounting, how financially the business is growth and how the the whole business is financially strength, how it is, they ascertain, evaluate and exhibit. These 3 points will be done in the financial accounting. Okay, the next comes accounting concepts. This I have written it in a sentence. Okay, in my notes which I provided to the students. So my accounting theory theory book which I provided to the students, I charge it rupees 150 for the for accounting book, where you will get only the theory part being explained here in detail. In my own words have been explained. Okay, this is the book. And for the examination part, I just one day before I just need to revise it, so I have prepared this book. As I'm explaining the video, I'm just going on writing it. So just that this book it is. Okay, so in that I have in this book which I provided to the students, I have written it very neatly and explained it very in words, and this whatever like how the student should write in the paper, in that thing I have written. But while explaining, while just revising before a day, you just need to revise whatever you have studied it, you just need to revise it. So that I have done here. Okay, so accounting concepts, there are accounting concepts: entity concept, money measurement concept, going concern concept, periodic accounting period concept, accrual concepts, matching concepts, revenue realization concepts, historical cost concepts, dual aspect concepts. Okay, in this accrual concept is asked twice, so I have just written it down how we have to explain this. Okay, first I'll start. Even I'll read out this also, accrual concept. Short note that asked for 5 marks in June 2019. So accounting concepts, the first one is entity concept. Entity concept is nothing but where the business enterprise and the owner of the enterprise are two separate entities. They have their own identity. Okay. Next one is money measurement concept. Money measurement means the financial accounting is nothing but uh, the transactions which are measured in terms of monetary terms. Those are uh, those are recorded in the financial accounting. So whatever the transactions in either we have paid in cash, or we have paid in check or bank draft, anything, it should be measured in money terms. Okay. Next one, going concern concept. So you should never think, when we start a business, you should never think that the business is going to end it. Okay. One day or the other, due to some reasons, it is going to end, but not you should never think that business is going to end it, we are going to make loss and we are going to shut down the business. No, business, we should and when we start, we should think that we will continue in the future. Going concern should be there. So it is assumed that we will continue the operations in the future, and there is no this we have to make more sales, more profits. That concept we should keep it in the mind. Next comes periodicity or accounting period concept. So there is a fixed period of accounting, that is accounting period. Either the accounting period is from January to December or April to March, where we are going to prepare the financial accounts. Okay. Next comes accrual concept. Accrual concept is what all the transactions are recorded in mercantile basis. Okay, here I have explained it in detail. I'll just read out that because it is important. As per the accrual concept of accounting, all the transactions and events of the business are recognized on the mercantile basis. So what it is, I have explained here. All expenses and losses, incomes and gains are recognized in the period during which they have been paid or earned. So all the expenses have been paid, all the incomes have been earned, irrespective of the fact whether they have been received or not. Okay, like this you have to write it. Revenues are recognized when they are earned, expenses are recognized when they are incurred, not when cash flow occurs, that is not included it. Okay, and then they are recorded in the accounting records and reported in the financial statements of the period to which they are related. So if now they are related to this accounting period, like 2012, suppose the 2012 any expenses has been paid, so salary is been paid to the employees in 2012. So in that accounting period they have been recorded. So that is accrual concept. Okay, matching concept. Next comes matching concept. Matching concept is where all the revenue are recognized during the period. The corresponding expenses should be recorded during that period. So all the revenue which have been incurred are to be recorded during that period. That is matching. It should be matching. Debit matches with the credit side. Debit is debit. If we have debited something, we have to be credited it. So that is matching concept. Next comes revenue realization concept. Only at the time of the sale of asset, amount should be revalued. Okay, I'll explain it here. As per the revenue realization concept, any change in the value of asset is to be recognized only when the asset has been sold and amount has to be realized. So every year we provide appreciation, and suppose if we have made any changes in the value of assets, like we have just installation we have done during this, and then we have oil date, we have been repaired it, these all things, it should be when it should be at the time of the asset being sold, that time we should realize it. This means that the company does not need to revalue their assets every year as per the realizable value. However, they need to adjust the cost of the asset when they are sold. So when we are selling, that time we have to see how much expenses are made, how much depreciation is done. That time we have to revalue the asset. But every accounting period you have to revalue. It's not necessary according to this concept. Okay. Next comes historical cost concept. The assets are being measured at the historical, means at the cost of original cost of the price. Now suppose the machinery is of 10,000, so at 10,000 it should be measured, it should be written at that value. And this concept is mainly applied to the fixed assets, because current assets are valued at cost or market value, whichever is realizable. So current assets, it is measured at whichever is realizable, at that that value it is measured. So for long term assets like fixed assets, machinery, furniture, furniture fittings, in that case it is being measured historical, the original price. Next comes dual concept. Dual concept is nothing but the double entry system of bookkeeping. It has every transaction has two effects, that is debit and credit. Okay, I'll just explain this part, this is important. Effect of the change in asset. If the asset changes, what all happens? If the one asset increases, the other asset decreases. If one asset increases, the another liability increases. A decrease in one asset will be increase in another asset. Decrease in one asset will be decrease in liability. So when asset increases, that is increase in one asset, okay, one asset increases, the another asset will decrease. That only when one asset decreases, the another asset will be increased. Same rule, one asset increases, liability also increases. If asset decreases, liability also decreases. Okay, how the change effect of change in liability it is shown. In one liability increases, the another liability decreases. Okay, one liability increases, even the asset increases. One liability decreases, another liability increases, and one liability decreases, the asset also decreases. Okay, next comes concepts. Three concepts are there. Okay, conservatism concept. This concept states that the accountant should not record anticipated income, but they need to record the anticipated losses. So whatever any loss is been any loss has been incurred in the business, it should be recorded. You cannot miss any losses. Even if you miss one profit, or even if you miss one income, it is okay, but you should never miss any losses. Okay, it is based on the conservative principle, which means that all the possible expenses and losses are reported, which have not even occurred yet. Even if it is not occurred and you know that there is going to be a loss or expenses is there, you have to record it. But in case of incomes and gains, if you don't record it, means if you miss to record it, is also okay, but you should you should not record leave any losses or expenses. Incomes and gains are recorded only once they are released. Means now suppose income we have received any interest this year, then we have to report it. But if we are going to incur any losses next year, but we know we are going to incur any losses, so we have been given as we have sold it, and we are not going to incur in the next period, but still we have to record it. Even if it is not occurred it yet, we have to record this is the conservative concept. Next comes consistency concept. Consistency means we have to be continuous follow the accounting policies. Whatever the accounting policies are there, we have to continuously follow one policy should be followed. Like in depreciation, we have, if we have started with the straight line method, we have to complete it with the straight line method only. You cannot be continuously changing some. Now today this month we have done straight line method, next month they are doing the other entity is doing WDV. So you cannot change continuously. You have to continuously do one method, one accounting policy you should follow. Next comes materiality concept. So materiality concept is nothing but which affect financial statements should be recorded. Okay, according to the materiality, all the items which have significant effect on the financial statements should be disclosed, and all the items which are insignificant in value and will only increase the work of the accountant but are not relevant to the user should be ignored. So stick to the materiality. Which all items affect the trial balance, profit and loss account, balance sheet, financial accounts, those have to be recorded. Unnecessary insignificant values which are, if only increases the work of the accountant, you should ignore it. It is not relevant, you should ignore the points. Okay, these are the concepts, accounting concepts. So you need, for short notes anything can be asked. Accrual concept has been asked twice, so but even other concepts are very important. Okay, now we saw difference between accounting concepts, objectives of accounting. In the last class we had seen, this is the difference between. Okay, next class we will see about the capital expenditure and revenue expenditure, difference between what capital expenditure means, what revenue expenditure means, what revenue receipts and capital receipts. These two differences we will see in the next class. Okay, these three differences.
If you like my video, please share, subscribe my channel and press the bell icon for more videos. Thank you everyone.